Hi there! We are here to talk about reserve requirements. Under the topic Monetary Policy. So what is monetary policy? It is basically the monitoring and managing of money supply by a central bank. There are two types of monetary policy. We have the expansionary and contractionary monetary policy. Expansionary or easy money policy occurs when the BSP tries to increase money supply by expanding excess reserves in order to stimulate the economy, with the goal to reduce unemployment. Contractionary or tight money policy occurs when BSP tries to decrease money supply by decreasing excess reserves in order to slow spending in the economy during an inflationary period, with the goal to reduce inflation. So what is reserve requirements? Reserve requirement is the amount of money that a depository institution is obligated to keep in vaults in order to cover its liabilities against customers' deposits. Raising reserve requirements increases required reserves and shrinks excess reserves. Any loss of excess reserves shrinks banks' lending ability and therefore decreases the potential money supply by a multiple. Lowering the reserve requirements. Lowering the reserve ratio decreases the required reserves and expands excess reserves. Gain in excess reserves increases banks' lending ability and therefore increases the potential money supply by a multiple amount of the increase in excess reserves. Here are the following formulas for computing changes in money supply. Imagine that there is a person who is about to deposit 1,000 pesos. There will be two scenarios where the reserve ratio is at 10% and 20%. Here is the solution for the said scenarios. Money supply can increase by 4,000 at 20% reserve ratio. Money supply can increase by 9,000 pesos at 10% reserve ratio.